They're pulling back today from record highs. Investors digesting some hawkish Fed commentary, another inflation report, looking ahead to the start of the third quarter earnings season as well. Joining us here, Post 9, Charles Schwab's chief investment strategist, Ann-Sonders, and senior investment strategist, Kevin Gordon. Well, this is a treat.
Yes.
Good to have you both here.
Thank you.
Scott.
Congrats. So it's the 15th anniversary of Charles Schwab ETFs. That's why you're here, and you're going to be up on the podium, right?
We won't be on the podium.
What?
Our
More
colleagues
important,
will.
our clients.
Oh, okay.
Yeah.
All right. Good answer. Good answer. Let's talk about this market, okay? Where your clients are looking to make money. How does the market look to you right here?
So I think in terms of the economic data, we are in a good news is good news backdrop for the market. I think some of the recent wobbles probably had a lot to do with a break above 4% on the 10-year.
Yeah, it backed up.
Yeah, so I don't know that was sort of some precise trigger point, but I think that there was maybe a little indigestion that kicked in when you saw yields across the spectrum move up. And that was in contrast to, I think, what the expectation was when the Fed launched an easing campaign.
Of course.
So I think that's the fundamental explanation.
Is that a problem now for your outlook on stocks, now that we have what might be, as Ann said, this new paradigm for what yields are going to do?
Well, it's interesting because as this has happened, where you've seen yields creep back up, and arguably you could say they overshot in terms of expectations for where Fed policy was going and being a little bit too dovish. But what's interesting is that the correlation between stock yields or stock prices and bond yields has flipped marginally back into positive territory. So all else equal, which of course is never always the case, but all else equal, anytime you've got yields moving up, it's not necessarily putting as much downward pressure on stocks. That's not going to be the case every single day. But if you go back into that environment where, to Lizanne's point, good news being good news again, and you don't necessarily have a lot more pressure from the bond market because presumably if inflation is not as much the issue anymore, then yeah, you probably don't have as much of a hostile scenario as you have in the past couple of years. I think even if you zoom out and you look at the 10-year yield over the past couple of years and you look at these key points where you've broken 4%, some of them have been consistent with a correction in the equity market, but over time you have trended higher. So it sort of speaks to the fact that it's not necessarily the level itself of rates that matters as much, maybe sometimes as the
why, if they're going up for the right reason.
Yields keying off of economic data is a better backdrop for the equity market than yields keying off of inflation data. I think that would revert that correlation back to negative if we saw a continued acceleration in inflation. You started to see yield moves tied more to the inflation data.
The right reason versus the wrong reason that yields continue to go up. How are you feeling about earnings, which are getting started tomorrow?
The earnings backdrop has been an interesting one. If you think back to the worst part of the pandemic, when you had a record percentage of companies that withdrew guidance altogether, we're obviously moved away from that. But I actually think that a lot of companies took advantage of the COVID backdrop to not go back to the kind of precision in guidance. In many cases because, and they've been very vocal about saying this is not how we manage our business on a quarter-to-quarter cents per share. And so I think what that's had the effect of doing is analysts are a little bit closer to the vest in terms of the adjustments they make to earnings. So when we were in second quarter earnings season, which was good from the perspective of the bar got lowered and companies did well, the outlooks were a little cloudier, and analysts therefore adjusted down earnings for the third quarter, cut earnings by about half, but didn't really move the needle much in terms of fourth quarter into 2025.
Yeah.
So if you look at consensus, it suggests, we're going to have this dip in earnings in the third quarter, and then we're just going to rebound right back up in the fourth quarter. I don't know how realistic that is. It's just reflective of companies listening, or analysts listening to companies during the earnings season and making adjustments really only one quarter out.